strains of public opinion with his argument.
And we don't want to go too far with this discussion. Thanks, John. From national security to market insecurity, we go to CNBC's Bob Pisani, who has the rundown on today's market reaction to all this news.
Stocks declined today, although it was on light volume, and we did stage an impressive rally towards the close. Let's take a look at what happened. It was all about the dollar. We hit some of the weakest levels of the year on the U.S. dollar, and that normally would be a big help to certain sectors like commodities and commodity stocks. But that didn't happen today. That's because there was a lot of worry about the AAA rating of the U.K. and the United States. Bill Gross of PIMCO on our air in the middle of the day talked about the U.S. may eventually lose that AAA rating, although most people feel that that is a very remote possibility. It did affect the stock market. Commodity stocks, which had been up and normally would be up on a day when the dollar is weak, were all down 5 to 10% today on some of the big names. Regional banks were also weak here, and this is a very unusual situation because we had a day when regional banks were very weak and some of the big national banks actually were slightly on the upside. Some traders talking about the fact that the U.S. supporting bigger banks might give them a competitive advantage. Finally, we did see General Motors spiking in the last hour here. Automotive News reporting that Italian car maker Fiat submitted 2 versions of its offer for General Motors Opel and Vauxhall units. That caused the stock to spike towards the close. Back to you.
Thanks so much, Bob. And AIG CEO Edward Liddy is stepping down, and Bank United was closed by the Office of Thrift Supervision late today. CNBC's Mary Thompson joins us now with the latest. Mary.
Thanks, Rebecca. We're going to start with AIG. Liddy told the board of his decision today. Less than 10 months into his $1-a-year tenure as CEO and chairman of the troubled insurance giant, Liddy asked the board to find replacements for each of these roles following the company's annual meeting on June 30th. Now, Liddy's departure is not a surprise. Reports last week said the trustees overseeing the firm would ask a revamped board to find a permanent replacement for the 63-year-old Liddy. The former chairman of Allstate, Liddy, was asked by the government to run AIG last fall. After 3 bailouts, the government owns 80% of the company and is on the hook for about $180 billion in loans and backstops. However, Liddy's plan to repay the government through asset sales has been slow to take off, in large part because a lot of potential buyers are facing financial troubles of their own. Liddy also faced scathing criticism earlier this spring from Congress. This about bonuses paid to employees at the units responsible for AIG's near failure. Liddy's response: he was legally obligated to contracts signed before he took over, failed to placate lawmakers. Separately, AIG is asking shareholders to approve a 20-for-1 reverse stock split at the firm's annual meeting. This is being done so the firm can maintain its listing standard, the listing standards, I should say, required by the NYSE. And in news, of course, with big implications for troubled banks, the FDIC has brokered a deal with a group of 8 private equity firms. The group is buying the banking operations of the failed Miami-based Bank United FSB. Now, reports say at a cost of $4.9 billion to the FDIC, this failure is the costliest of the year and also the largest of the year. Through this deal, the new owners, who include private equities W.L. Ross & Company and Blackstone, the two have entered into a loss-sharing agreement on $10.7 billion of the company's assets with the FDIC. In return, these investors are going to be injecting $900 million in capital to keep the bank afloat. And for Bank United customers, this is important. The branches, there are 86 of them in Florida. They are going to be open for business as usual tomorrow. Now, calls to the FDIC weren't returned, so we don't know the terms of that loss-sharing agreement. But in a press release, the FDIC did say because of private equity's interest in failed banks, it is going to disclose guidelines for these types of investments in the future, and that is critical. A number of people have been looking for private equity money to come in and help with the troubled banking system, and it appears that the FDIC is getting close, at least, to providing some kind of outline for this. As far as the 8 partners here, John Canis, who is going to be managing the bank, says this is probably the start of a number of acquisitions they are going to make in Florida of troubled banks. So that's something to watch. Rebecca, back to you.
Thanks so much, Mary. And our markets secure? What is weighing on them the most? Here to debate and discuss is Mike Ozanian of Forbes magazine, Michael Pento, senior market strategist for Delta Global Advisors, and David Dietz of Point View Financial Services. Welcome to the program, everyone. Michael P., let's kick things off with you. This UK news today, right. Bob Pisani mentioned it. A lot of traders were talking about it on the floor, plus the idea that maybe the U.S. is in just as bad of a position as the UK.
It's
worse, in your opinion.
Well, who cares what Standard & Poor's says anymore? Do they get anything right with the monoline insurers or AIG?
So does that mean they're already late to the game this time?
We should be downgraded, but we have a fiat currency, so I guess we can print our way all the way to prosperity and pay back everybody in worthless dollars, so we'll never really go bankrupt as a country.
David, you don't agree with that, do you?
Well, look, You know, the 10-year Treasury was at record low rates going into this year, about as low as 2.5% in March. And so no one thought that was going to last. So what I see now is gradually that 10-year Treasury is moving up in yield. That's not because people think the United States is going bankrupt. That's because risk appetite is coming back into the markets. Money is rotating out of Treasuries, going into stocks.
You mean inflation, right? You mean inflation, right? Because oil is over $60 a barrel. The dollar is down 10% since March, but we're not supposed to be worried about inflation.
Quite frankly, I don't see the inflation. Oil is less than half of what it was last summer. No one who owns a home in America
is double what it was
seeing any inflation.
Is not inflation part of the point here, though? I mean, they wanted, with these programs, to at least put a bid under house prices and potentially stock prices as well.
Exactly. Their whole scheme is to get home prices stop falling, but that's the last asset to respond. That's the asset just as exiting an asset bubble. That will be the last asset to respond.
All right, let's get Mike O in on this. What's your take?
I think Mike's got the economy correct, but I think the stock market had overreacted on the downside. It's down about 45%. The S&P is from its 2007 peak. Earnings are only down 25, 26%, so I think it's overreacted. I would hedge my bet on equities, though, with gold, and I would go short the dollar.
All right, short the dollar, but you mentioned the fact that it's down 45%, but still, in these last couple of months here, what we've seen, well, since March, what we've seen is this huge run-up, 30% plus. Do people take money off the table here and wait for things to come off a bit before getting back in?
No, I think we're starting to see the economy start to hit a bottom. The Purchasing Managers Index in April showed more managers now expecting orders to go up than go down. Consumer confidence has been up the last 3 months.
Isn't that bottom what triggers the inflation issue? I mean, aren't they linked?
No.
Let me finish. Before you tell me the question, the answer, let me give you the question.
It's the only way you can get it right.
That until the banking system begins to function, you don't have monetary velocity. Everyone agrees.
No.
Everyone agrees they've created a lot of money, loads of money, unprecedented amounts of money, right?
Reserves.
And then it's just sitting there. So it's not money in existence that matters. It's money in circulation that matters. So once it circulates, then you get the inflation. Correct?
Not entirely. M2 is up 9% each of the last 3 months.
Yes.
That's an inflationary signal. And as Mike said, look what's happened to the dollar.
Well, it's not what I just said.
Look what's happened.
As we hit the bottom, we start to come up, the money starts circulating, and that's inflation.
It's
The dollar's had a lousy month, hasn't it?
Very lousy month, and the long bond got killed today.
It's down 10% from its March lows, the dollar.
We've got a long way to go before inflation.
How long?
How long? Well, you tell me when unemployment starts to improve. I mean, remember, 70% of the cost of what people buy at retail is wages. Now, with the unemployment rate...
Unemployment was high in the 70s. We had high inflation.
No, exactly.
Those were oil shocks, though. This is a totally...
We haven't had an oil shock?
No, we really haven't compared to the 70s.
And maybe go up to 70 or 80?
Oil was at 150. Now we've had a shock going the other way.
But what we're also seeing is investing in commodities as an asset class in relation to the dollar's weakness.
Now you're talking.
So as opposed to following necessarily the supply-demand factors, what we're seeing is people looking at these things as hard assets to own. All right.
Right, you
I want to ask
no. You asked me after the music's. We got to go.
I thought you were
I'm a newbie. I got to do this right. I'm not like Larry. I can't break the rules. You all have more work to do, so don't move. Coming up, the spring mustard seeds have been planted and are being watered by a very unlikely source. Is the economy on the rebound? We'll debate. You're watching the Kudlow Report.